Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today's Friday. It's March 18th. Don't ask me where the year has gone. I have no answers. I don't know where last week has gone, but we're deep into March. Today's Friday, as you can see here, and it's about 7:48. Market's going to open up in about an hour and 45 minutes or so, give or take. As you can see here, the Dow is down about 187, which is not all that significant in light of the fact that the volatility has been going nuts and the average daily move has been about 400 or 500 points. Actually, let's take a look. You know what? I've been dying to know this. Let's take a look at the ATR. I want to know what the average volatility has been on the Dow. It really is an interesting question. So let's take a look. ATR, 10 days. Let's take a quick look here. The average, look at this. This is what the average volatility has been per day. 600 points. This is the DIA, the diamond, so it's in hundreds, not in thousands. But if you look here, you could see right here that the volatility, and look at it. Look at the volatility in January. $3, $4, that's 400 points, all the way up to $6, and it's still near there. So we're seeing swings of 600 points a day on average. That's how much volatility we're having. And this is why I say when we see the market up or down 100, 200 points, it's not as significant as it was 6-7 months ago. So again, I wouldn't make too much out of these swings because the ATR, the average volatility, is 600 points a day. So imagine the average volatility per day is like 150 points in the Dow, right? That would be equivalent to seeing a move of 50 points up or down, which would be completely random. So in the big scheme of things, in light of this is only a third of the day's move, so it's kind of random. But the NASDAQ is down quite a bit more. And the ATR, the indicator I just showed you, it's a great indicator to use to find out what the range has been. Volatility is a hair higher, not too much higher, just a little bit higher. It's been within this range now for a while. It went a little bit higher beginning of the week, but now it's lower. And I don't even know why we're looking at VXX. That's a tradable asset. We should be looking at VIX, but they're now back to kind of saying the same thing. The fact is volatility is down, and it may go back up, but I think the worst may be behind us. Put to call ratio is still to this day. Look at this. We're still in the upper end of the range, and we haven't broken down. If you look at it in these two periods, you will see that this is when markets are really, really bullish, and this is when markets are really bearish. And we're still within that range, which means I'm expecting more upside, especially in light of the fact when you're looking at momentum levels and you're looking at stocks trading above or below the 200-day moving average. Let me just show you something here. Let me go down here. As you could see here, we're pretty close to the bottom. I mean, this is all the stocks in every indice trading above $2. And even when you're looking at this, you could see we're not all that far off the bottom, and we actually hit the bottom a little earlier. This here is COVID, and this here is 2018 rate hike. And these two environments, I don't know about this one here, but this environment was much, much worse. Now, if you look at the NASDAQ, you will see on momentum levels, because the NASDAQ is the troublemaker that got us here, you will see that number is actually even lower. Here, let me do an area chart. You could see here on a 5-year basis. There we go, on a weekly basis. This is 2000. This is the COVID. This is 2018. We're right there, and we're bouncing off of it. So again, I don't know if there's that much more downside in the stock market. The bond market has completely priced in the Fed raising rates. As you could see here, since the Fed announced they're going to raise rates 1/4 point, we haven't had much of a move in the bond market. I'm expecting the bonds to go up to about the 137, 140-ish level, and then I'm going to sell them again. We can't sell them right now because we want to go with the trend, and the long-term trend is lower, not higher. Let's talk a little bit about global economy, and I'll talk about news. Now, as far as news, we had industrial production yesterday. It was mixed. The manufacturing output was not too bad. The capacity was not too bad. And the housing starts, the jobless claims, the numbers were not that bad. Today we've got existing home sales. Not really focused too much on that report because home sales have been very, very stable. Let me go through global economy, and then I'll talk about technical numbers with you or levels. Shares have opened lower in Europe, and after gains for most Asia benchmarked as oil prices hovered above $100 a barrel. Ukrainian President Zelensky called for more help for his country after days of just craziness. The war plans for Joe Biden to speak with Chinese president later today were among some of the uncertainties, although nothing gets resolved with our talks with China. They just continue and continue. Wrapping up two-day meeting, the Bank of Japan opted to keep its monetary policy unchanged. Smaller companies have been outperforming the market, which is something I want you guys to pay attention to because the Russell has the most speculative stocks. And if you look at the Russell, it's actually been moving higher, not lower, which is a very, very bullish indication that the market's actually going higher. And if we can break above this level right here on the Russell, where we're at right now, it would be very, very bullish. But small caps are more speculative and they have less interest rate sensitivity. And the fact that they're moving higher is a very strong indication that the markets have bottomed out. Also, if you look at our best friend Kathy Woods, I'm being sarcastic. If you look at most of her stocks, look at this. She went to a high of 159. We're right at the base. We're right at the inflection point of COVID, right here, literally right here. So as far as I could see, and it doesn't mean that these small cap stocks can't just stay there forever or for the next 2 years building a base. But I'm talking about the bottom. Everybody's looking for a crash, and I'm trying to tell people that we're kind of there. So let's talk a little bit more about the market. Big swings in markets have been the norm. I showed you the ATR. As investors struggle to handicap what will happen to the economy and the world's high inflation because of Russia's invasion of Ukraine. High interest rates from central banks around the world. Renewed COVID worries. Oh my God, I thought, this COVID, it's like the gift that doesn't stop giving. Wall Street's latest gains came after Federal Reserve raised its key rates on Wednesday for the first time since 2018, and we have not seen any movement on the bond market, which is telling me it's priced in. Crude oil is now again above $100 a barrel, and it's going to, or should test the recent highs. That is something we need to pay attention to, and we have a position in Sniper, one this position right here that we're probably going to take profit off today if it goes just a little bit higher. Reports of Russia crude oil sales to India are floating around, but so far, India hasn't said anything. Dribbles of news about state of negotiations between Russia and Ukraine have caused many of the sharp reversals. So too recently have worries about the economic shutdown in China. It's like a double whammy. I did not think this COVID was going to be an issue again. This is something that has not been part of my calculation. I thought finally it would be over, especially in China. On Thursday, Chinese government said companies in Shenzhen, a major business center, will be allowed to reopen while efforts to contain COVID outbreak progresses. I think they're finally learning something, that closing things down isn't going to help things. A wave of better than expected reports from the U.S., that's what I talked about earlier today, may also help the markets. Builders broke more ground on homes last month, and unemployment claims they went down. So, looking at the SPY, and I am looking at the Russell right now very, very closely. Looking at the SPY, the market wants to open reversing almost everything we undid yesterday. But we are near the 200-day moving average, and the next area of resistance is the 200-day moving average. If we can pass the 200-day moving average, there's going to be a large influx of buyers coming into the market, and we're going to see a lot of short squeezes. That level is 446 on the Dow. I would say 447 just to be on the safe side. Or if you're trading on the SPY, not the Dow, on the SPY. I don't know why I'm talking Dow. It's 446, 447-ish. On the Dow, that number is 350. I would just say 351. So 35,100 on the Dow. It looks like we're going to hit it. And again, I like how the Russell is looking. And I like how the Russell has actually been outperforming the market and holding on pretty well around here. On the QQQ, we still have a while to go, so I want to see us break above the 351 level and then the 368-ish level. Keep an eye on those numbers. Now, also, I want you to take a look at semiconductors, because semiconductors are very important right now, and semiconductors are also looking to go higher. So the 200-day line on the SMH is 273, 274. Keep an eye for those levels. If we break those levels, the market will start getting bullish, because you're going to get a lot of short squeezes when we move above the 200-day line. And the hedge funds are going to start really liking this market. So again, we're coming off of oversold territory. The market is looking bullish. Now, looking at my stock fetcher code, just to give you an idea of where things stand right now. Looking at the 11 major sectors on a cumulative basis, there's no question energy, utilities, but now healthcare is superseding consumer staples. So keep an eye on that. That's a very, very important factor. Also, the fact that consumer staples is moving lower, not higher, makes the market less defensive, because defensive stocks are consumer staple stocks. But they're still in this category, and I wouldn't rule them out. On a 6-month basis, energy, utilities, consumer staples, the 3 most defensive sectors. I would stay with this regard. This is the best way to do this right now. That's more likely going to be the future for the foreseeable future. On the downside, we have consumer discretionary, technology, and communication services. Those are the 3 weakest sectors. And although I'm looking at XLK, let me give you that magic number on XLK. It doesn't seem like we're going to hit it unless we have a major rally in the Dow. Now, we are trying to supersede those levels, but look how weak we are. The fact that we're choppy is positive, but we need to break higher. And again, I'm not going to be too confident in consumer discretionary or consumer speculative stocks, retail stocks, till we're above the 200-day moving average, which is near the 187 level. So if I were you, I would be again looking at all the stocks that have been moving higher the last couple of months. You've got Occidental Petroleum, Mosaic, Industrial, the metals, the energy, the natural gas stocks. Those are the stocks that you want to look at right now. Those are the stocks that are hot. The non-energy stocks would be the Dollar Tree, Kroger. Let's see here. Freeport, that's copper. Newmont, AbbVie, that's a medical stock and looks really good right now. I always like to look at stocks that are moving up the ladder that are not related to the main area that are up. And those are the 3 stocks: Kroger, Freeport, Newmont Mining, and AbbVie. So you got a medical stock here, you got Dollar Tree here, you've got Kroger here, and you've got gold. So gold, copper, healthcare, Dollar Tree, a little consumer staples, discretionary, and again, consumer staples right there. Aside from that, Mosaic right here, basic materials, and industrial. But everything else is energies, and energies. That's what's hot this week. Keep an eye on those levels next week. Till we break those levels, till we break above, until we break above the 200-day moving average, nothing fun is going to happen for consumer staples, tech, or energy. Similarly, till we break above, let me give you that level on SMH. Above the 200-day on the SMH, nothing's going to happen. So right now, we remain choppy and defensive. Now, folks, I've got something important for you. New Money Crew head trader Lance Ippolito, he's back. He's back in the spotlight with a great new opportunity for you. At the start of the year, JD.com wasn't doing much. The stock had already been in a death spiral since major shareholder Tencent Holdings offloaded its shares in the e-commerce. Now, Lance thought the bloodshed was over, but he was wrong. The stock barely budged over the course of this week, but Lance still collected 34% return on investment, and it's all thanks to his 0.30 formula. Now, you've got to check out this 0.30 formula. It's red hot, and Lance is on a streak, red hot streak right now. Click on the link below and see how Lance was able to capture the value out of JD.com as well as others. Folks, don't miss out. Monday we'll do a full week update, see where we stand, give you update on all new ETFs and stocks to keep an eye on, and talk about new levels. Meanwhile, follow the link. Don't miss out on Lance. He is red hot. This 0.30 formula is very, very cool. You've got to check it out. Follow the link below. Have an amazing weekend. Send me some letters. Support@marketgeeks.com. Bye.